The economic consequences of a protracted trade conflict would be severe, but it would be very different, a very different shock than the COVID-19 shock. In the pandemic, we had a steep recession followed by a rapid recovery as the economy reopened. This time, if tariffs are long-lasting and broad-based, there won't be a bounce back. We may eventually regain our current rate of growth, but the level of output will be permanently lower. It's more than a shock. It's a structural change. The first thing we would see is a marked decline in exports. As Canadian goods become more expensive, U.S. demand for those goods would decline. A lower Canadian dollar would provide a partial offset. In our model, with the scenario based on the February 1 executive order, exports fall by about 8.5% in the year after tariffs takes effect. That's the green line. Canadian exporters respond by cutting production and laying off workers. With exports to the United States accounting for roughly 1/4 of our national income, the shock will be felt across Canada. Lower export revenues would reduce household income, and retaliatory tariffs would raise the prices of many consumer goods. As a result, consumer spending on everything from cars to entertainment to housing would slow. With export and consumer demand weakening, Canadian businesses would also cut their investment spending, and higher costs and lower profit margins would restrain investment further. With retaliatory tariffs on some goods and a lower Canadian dollar, businesses will face higher import costs. Canadian businesses, and I'm looking at them, buy roughly half of their machinery and equipment from the United States. In addition, profit margins are squeezed because higher costs are gradually passed on to final goods prices in Canada. So what would this all mean for economic growth? Well, in our January projection with no tariffs, we forecast growth of about 1.8% in both 2025 and 2026. But in the tariff scenario, the level of Canadian output falls almost 3% over 2 years. That's the blue line. That implies tariffs would all but wipe out growth in the economy for those 2 years. But if we are faced with a prolonged trade conflict, the only way to offset this negative structural change is with a positive structural change. Now, structural policies are appropriately the responsibility of elected governments and parliaments, not the Bank of Canada. So I will tread lightly here. The bank has previously highlighted Canada's productivity challenge, and it's good to see more focus by federal and provincial governments on structural reforms to increase productivity and investment by strengthening our economic union. Removing rules that restrict interprovincial trade or harmonizing or mutually recognizing provincial regulations could provide some offset to the increased trade friction with the United States. Provinces could also make it easier for workers to move within Canada by mutually recognizing different labor accreditations. There is also scope for all levels of government to reduce the timelines and uncertainty related to regulatory approvals. And better east-west transportation links would make trade within Canada less expensive and help get Canadian products to overseas markets.